Doris. I'm here to share with you about the market update. Today we're going to be talking about the U.S. banking crisis. It is far from over yet. The Federal Deposit Insurance Corporation announced in the early hours of May 1st that it has seized First Republic Bank and sold it to JPMorgan Chase, making it the third bank to fail since March and the second largest in the U.S. history since the Washington Mutual collapsed in 2008. The FDIC said that JPMorgan will control all deposits and assets at the First Republic, where its 84 branches will become the bank. Its incident shows that the U.S. banking crisis is far from over, and the problems still existing in the U.S. banking industry and are waiting to be exposed and resolved. The collapse of SVB hit the First Republic hard. It is a commercial bank and provider of wealth management services based in San Francisco, California. It serves high net worth individuals with 94 offices in the 11 states, mainly in New York, California, Massachusetts, and Florida. The bank was founded in 1985, made an initial public offering in Nasdaq in August 1986, and then again in December 2010 through a series of acquisitions with total revenue of $6.8 billion and a net income of $170 million in 2022. The collapse of SVB on March 10th hit the First Republic Bank directly. In the face of the crisis, investors need to figure out which other bank could face similar risks to SVB. The investor reaction directly caused the First Republic Bank shares to fall 52% on March 10th, and then rallied sharply close to the previous day's close, and then fell another 15%. Investors expressed concern about the bank's unrealized assets and its heavy reliance on deposits, which could prove unreliable. The First Republic issued a midday statement trying to reassure investors about its continued security and stability, and a strong capital and liquidity position. The bank's stock then fell 34% over the week. Investors' growing vigilance about the First Republic is similar to concern about SVB. Like Silicon Valley Bank, there is a huge gap between the fair market value of its asset and the balance sheet value. Unlike Silicon Valley Banks, First Republic Bank's problems are largely in its loan assets. In the face of Silicon Valley Bank caused the banking crisis, Fitch Ratings and Standard & Poor's downgraded the First Republic Bank's credit rating. The reason is that the wealthy customers' unsecured deposits proportion is high. They're more likely to transfer money to other places. Loans and deposit ratio of 111%, which means that the bank borrowed money than customer deposits. In an effort to ease concern about the possible bank run, 11 American banks, including JPMorgan Chase, on March 16th deposited $30 billion with First Republic to support any deposit withdrawals. On March 19th, Standard & Poor's further downgraded the bank's credit rating to junk status by 3 levels. Investors' question on the true value of the First Republic Bank have long been inviolable targets in the banking sector. The bank's valuation is higher than most others, partly reflective of its service to premium customers, with 2/3 of its deposits exceeding the $250,000 insurance limit. Its clients include affluent individuals and businesses, and the market is mainly in the coastal areas. The company's lending business is focused on offering huge mortgages to customers like Mr. Zuckerberg. Few of these loans ever went bad. At the end of 2022, the bank has assets about $213 billion and $176 billion in deposits. But when the crisis came, investors began questioning the true value of the First Republic Bank. The shares of the 11 big banks, despite injecting $30 billion in deposits into First Republic, fell sharply on March 17th. The stock is now a little over 30% than tangible book value. The S&P 500 banks overall, according to FactSet, that is a big discount because investors struggle to find an anchor valuation. When under pressure, investors tend to stop making valuations based on banks' expected earnings and focus on book value. At the end of 2022, First Republic's portfolio lost approximately $4.8 billion, and shareholder equity exceeded $17 billion. SVB's portfolio had a book loss about $15 billion, and shareholder equity about $16 billion. As of March 17th, First Republic traded at a discount of more than 50% to its tangible common equity after deducting a pre-tax book loss. But whether the price is attractive to investors still depends on other judgments about the bank's future prospects. Unrealized securities losses are not the only challenge from rising interest rates. At the end of 2022, First Republic had $33 billion of deposits fixed residential real estate loans. It also has $62 billion in mixed-rate residential real estate loans that can be converted from fixed rates to adjustable rates. First Republic's residential real estate loans returned 2.89% in 2022. This challenged First Republic with a future net interest income equal to the interest earned from the assets minus the interest expense. It pays for the funds in 2022. The average interest rate is 0.4% for the overall deposits. More than 40% are checking accounts without any interest rate. The current overnight interest rate is 4.75% from the Fed, and the increased short-term borrowing from the Fed's housing bank is 5.809%. In other words, the Fed's interest rate hike directly threatened First Republic's earnings. The ultimate impact on banks' net interest income depends in part on how many deposits are replaced by new borrowings and how long banks have to borrow at these rates. If it is able to repay these loans quickly or get more deposits at an interest lower than new loans, it will help to stabilize and normalize its earnings. But in the context of the banking crisis, the First Republic Bank is uncertain. In other words, the true value of the First Republic Bank is a goal of change, leaving investors still scared even after the 11 big banks take rescue action. Share fell more than 30% or less on March 17th. Investors clearly don't believe that First Republic is out of danger. The results reveal the depth of the U.S. banking crisis. On April 24th, First Republic released its first quarter results, giving investors insight into how much the troubled bank suffered after a sharp outflow of deposits. The bank's fiscal first quarter profit fell 33% to $269 million from $401 million a year earlier. Revenue fell 13% to $1.2 billion. Much of the earnings span is before the deposit run forces the bank to get expense loans from the Fed, and which will inevitably squeeze future earnings. The bank said it will cut 20 to 25% and cut executive pay. So far, the First Republic's bank's share have fallen nearly 90%, lost $102 billion in customer deposits in the first quarter. The day after this earnings report, First Republic's share fell another 49.3%. The situation at First Republic shows that the U.S. banking crisis is far from over. It shares three characteristics with fellow Silicon Valley Bank and signature banks. First, banks are at risk of rising interest rates. As the Fed raised rates over the past year, many of First Republic's assets lost value because they were fixed at lower rates, and thus banks earn a lower revenue. At the same time, they had to pay higher rates for its customer deposits. The combination of falling revenue and rising costs could collapse the bank's balance sheet. Second, a large proportion of the three banks have deposits above the federal insurance limit. These depositors are more likely to be cautious and prepare for chance to transfer money because they know that they could not lose most of the money if the bank fails. Finally, the fortunes of the three banks are linked. The collapse of SVB has made Americans even more worried about the safety of their deposits, and the First Republic looks very much like the Silicon Valley Bank. The First Republic Bank has come to an end, but JPMorgan got bigger and bigger. First Republic's shares have fallen about 95% so far this year. U.S. regulators have once again moved in to close the First Republic to contain the spread of the crisis. The First Republic Bank has made the last journey of its independence. Federal regulators found buyers for First Republic, making JPMorgan even bigger. JPMorgan has $3.7 trillion in assets and 14% of the U.S. deposits. JPMorgan expects profit to add $500 million this year and will provide stable, affluent customers. It estimates the deal will cost $13 billion to its insurance fund. The U.S. government has tried to impose new restrictions on bank mergers in case the big banks get bigger. But on the First Republic scale, they acknowledge that the big banks have the power to intervene under financial pressure. JPMorgan Chase repeated the central bank, forcing other commercial banks to lend and boosting confidence. The 2008 American financial crisis shows that the rapid growth of big American banks caused them to be considered too important to the financial system to fail. Big banks will become extremely profitable, not only surviving the trial of regional bank failures over the past 2 months, but even thriving. JPMorgan led 11 banks that temporarily bailed out the First Republic in March. During the 2008 financial crisis, JPMorgan bought the ailing Bear Stearns and the bankrupt Washington Mutual. History seems to prove that the big banks play a mainstay in rescuing the crisis. Although JPMorgan Chase aided the First Republic to prevent the spread of the crisis, it did not eliminate the banking crisis. It is not certain that the First Republic is the last domino default in the banking crisis. The end of the U.S. banking crisis could depend on whether the depositors withdraw money from the institutions they deposit. If depositors lose confidence in their banks and run to their deposit banks, any bank before the crisis has the same fate as the SVB, Signature Bank, and the First Republic Bank. The collapse of the First Republic Bank once again shows that the magnificent bank was very fragile, and that the destruction of the bank came from the loss of confidence. SVB, Signature Bank, and the FR Bank are all audited by KPMG, which will face an investigation by U.S. regulators. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.